Let me tell you a secret. You can't run from finance and numbers by going into medicine. Whether you want to be a rich doctor or you just want to make enough money to make ends meet, becoming financially literate is your second job. You have to educate yourself on money and act financially conscious when you make decisions. Those are the key words. Write them down. If you get nothing else from this presentation, you should get these two words, these two phrases: financially literate and financially conscious. You need to be both. Say it with me. I am financially literate and financially conscious. Good. That mindset shift will help you with the daunting task of getting through medical school. As a pre-med student that could barely afford my first year of college, I understand the fear of probably not being able to afford medical school. However, we can't get through things by avoiding them. That's why I put this financial literacy course for medical professionals together, to educate myself and others on how to make our medical careers affordable. Because I won't let a bill stop me from having doctor before my name, and you shouldn't let it either. As future medical professionals, we have to educate ourselves to elevate ourselves. We need to educate ourselves on finance and make the needed mindset shifts to change our financial reality. In addition to becoming more financially literate, you need to adapt the mindset that having a written plan for managing your student loans is normal, and that you need to hit the ground running with a solid financial plan as you receive your first paycheck. Before we get into the nitty-gritty, I need you to keep in mind, the majority of my information has come from the White Coat Investor LLC, not a financial advisor, accountant, or attorney. I am not a financial professional either, just a student like many of you watching. As such, this presentation is for your information and entertainment only and does not constitute formal, personalized financial accounting or legal advice. I have not been approved, certified, or trained by the White Coat Investor LLC. In addition, I have modified some of the data to represent data changes post-2019. The original slides used by the White Coat Investor can be found at whitecoatinvestor.com. The accuracy of any and all information in this video should be double-checked using a reputable source, aka probably not ChatGPT. Okay, let's begin. There are 3 steps to understanding personal finance. Step 1 is to educate yourself through courses, blogs, and books. Step 2 is to put a written financial plan in place. And step 3 is to prioritize your continuing financial education. You have to learn the language of personal finance through courses, blogs, and books. Financial literacy, in terms of learning business, personal finance, and investing, is an individual endeavor. Medical school will teach you the language of medicine, and residency will teach you how to practice medicine, but neither will prepare you to manage your own money, let alone understand it. That is why it's important to educate yourself about your financial situation and how to reach your financial goals. Personal finance can be learned through a financial advisor, online courses, blogs, and books. However, with each option, you should weigh the pros and the cons. While hiring a financial advisor to teach you takes little effort, it can end up costing you thousands of dollars. If you take online courses, like the White Coat Investors online course, Fire Your Financial Advisor, it is much cheaper, but takes more effort than hiring a financial advisor. Books are very inexpensive, but require more effort. Blogs and internet forums are free, but require a lot of effort if you are sifting through blogs trying to find the most reliable and most suited to your needs. If you're watching this video, I'm going to assume that you know nothing about personal finance. So to jumpstart your financial education journey, I'm going to recommend 4 beginner-friendly books. For personal finance, you should read Personal Finance for Dummies by Eric Tyson. For investing, you should read The Bogglehead's Guide to Investing by Taylor Larimore. For behavioral finance, you should read How to Think About Money by Jonathan Clements. Then you should read The White Coat Investor's Guide for Students by Jim Daly for physician-specific finance. The cheapest and easiest financial book to get through is probably If You Can by William Bernstein. This 16-page PDF is provided for free in the description and also on the slides. After you read these books, the second step in your personal financial journey is to put a written financial plan in place. A financial plan is basically a document that outlines your current financial situation, establishes goals, and analyzes your budget and cash flow, and details the strategies needed to achieve those goals. A more advanced financial plan includes steps to manage savings and investments, create debt repayment strategies, manage risk, and address retirement and estate planning. In this course, we will walk through creating a financial plan that highlights the basics and debt repayment strategies without addressing estate planning. If you would like to read more on advanced financial planning, including estate planning and retirement, I would recommend the How to Create a Financial Plan article by PNC Banking. Okay, this document is an overview of how you can write your own financial plan. I outline 5 steps in this document. Step 1 is to assess your current financial health. Step 2 is to establish financial objectives. Step 3 is to analyze your budget and cash flow. Step 4 is to manage your savings and investments. And step 5 is to create a debt repayment strategy. So here's an overview. So let's talk about step 1, which is to assess your current financial health. Start by assessing your current financial health. This entails documenting your income, expenses, assets, liabilities, and credit. Review your credit score and credit report. You should track all of your expenses for a few months to get a realistic idea of where your money is going. Trust me, this is important. Don't skip assessing your current financial health. If you're wondering how to tell what's an asset or a liability, keep this in mind. Assets include savings accounts, investments, and property holdings. Liabilities include credit card balances, vehicle payments, student loans, heavy on the student loans, and other debts. Next, you're going to calculate your net worth. By subtracting your liabilities from your assets. After you assess your current financial health, you're going to establish financial objectives. Your financial objectives should be short-term, medium-term, and long-term goals. Okay? They will influence your decisions, especially in terms of spending and saving. Short-term goals are those that you want to achieve in the next 3 to 5 years. In the next year or two. I got confused for a second. So short-term goals are those that you want to achieve in the next year or two. Examples include building an emergency fund, paying off high-interest debt, or saving for a home renovation. Medium-term goals are those you want to achieve in the next 3 to 5 years, and long-term goals are those you plan to achieve in 5 years or longer. Medium-term goals are goals such as saving for a down payment for a home, starting a business, or funding a child's education. Examples of long-term goals are saving for retirement, paying off a mortgage, or achieving financial independence. For maximum effectiveness, here are the examples of short-term, medium-term, and long-term. Okay. For maximum effectiveness, make sure your goals are SMART goals. So they have to be specific. They need to clearly define what you want to achieve and when. They have to be measurable. Assign a dollar amount or percentage to your goal. They have to be achievable. Make sure your goals are realistic given your current financial situation. They have to be relevant. Ensure your goals are aligned with your values and overall financial plan. And they have to be time-bound. Set a deadline for achieving each goal. Here is an example. Save $10,000 for an emergency fund within the next 12 months. Okay? It's very realistic. It's very smart. Okay. What else did I want to show? In the financial plan example that I am currently looking at, I have based my financial plan off Dave Ramsey's 7 baby steps, which are right here. So this is a good way to start off making a financial plan. Like if you don't know what your goals should be, I recommend looking at Dave Ramsey's 7 baby steps to financial independence. It says, here are the steps right here. You can just read them for yourself, but I'll also read them. This is 1, save $1,000 for your starter emergency fund. 2, pay off all debt except the house using the debt snowball. We'll go more in depth about the debt snowball and what it is later in the video. Step 3 is to save 3 to 6 months of expenses in a fully funded emergency fund. Step 4 is to invest 15% of your household income for retirement. Step 5 is to save for your children's college fund. Step 6 is to pay off your home early, and 7 is to build wealth and give. So currently my financial plan is based off something similar. I don't have a child's college fund, obviously, in that plan, or to pay off my home early because I have neither of those things, but so it's like somewhat based off his plan. So once you have established financial objectives, plan out how you're going to allocate resources in a way that aligns with your goals. Okay, so you're going to analyze your budget and your cash flow. You should use the income and expenses you listed when assessing your current financial situation to determine how you could change your spending habits to make your financial goals more achievable. Remember, it is important to start with small, manageable changes and aim for consistency. After you have a picture of your current financial situation, establish financial goals, and create a strategy to reach those goals, you can manage your savings and investments. Okay? Here is an example of analyzing your budget and cash flow. Before you build an investment portfolio, it is important to have an emergency fund that can cover 3 to 6 months of mandatory expenses. To build an emergency fund, you should determine your savings goal. Then you should open a separate savings account for the emergency fund. Consider automating savings by setting up regular transfers from your checking account. The last part of creating a financial plan that I will cover is creating a debt repayment strategy. In future videos, I will cover student loan management and repayment in more detail, but for this video, I'm going to generally go over the approach of the mindset and strategy behind it rather than debt repayment tools and programs. On your financial plan, start by listing debts, including the creditor, the balance, the interest rate, the minimum payment, and the payment due date. And this is an example, dude. So if your financial plan debt repayment strategy doesn't look like this, that's like completely fine. This is just an example. There are 2 main debt repayment strategies: the debt avalanche approach and Dave Ramsey's favorite, the snowball method. The debt avalanche method involves making minimum payments on all debts while directing extra funds toward the debts with the highest interest rate. As you pay off each debt, redirect the payment amount to the next highest interest debt. The debt avalanche does not deliver the same quick results as the snowball method, but it could save you money by reducing the overall interest you pay. The snowball method entails targeting the debts with the smallest remaining balances first. So I personally like the snowball method because seeing those accounts getting paid off relatively quickly gives me momentum. I like the satisfaction of seeing each zero balance. Remember, writing a financial plan is important, but what you also need to do is regularly review and adjust your financial plan. It's important to review your financial plan once a year and after significant life events. This way your plan stays aligned with your current financial situation and goals, while also adjusting for changes in tax laws or financial regulations. Okay, so how do I review my financial plan? I'm glad you asked, because I have another list of steps for you. Assess your progress. Compare your financial situation to your original goals to identify where you're succeeding and where you need to improve. The second step is to reevaluate your goals. Your financial goals need to change if your priorities change. Make updates to your goals if need be. The third step is to adapt your financial plan to life's changes. Did you get another source of income? Are you spending money in a new way? These changes may necessitate changes in how you save, invest, and spend. Finally, optimize your investment strategy. If you have that 3 to 6 month emergency fund and are investing, ensure that your investment portfolio aligns with your risk tolerance and time horizon. Adjust your investment portfolio as needed to stay on track with your financial objectives. Remember, the cycle of creation and reflection is important. We don't write our financial plans in stone. They are not law. If we need to reflect, we reflect to make sure they align with our goals and lifestyles. We're just not going to over-reflect, though. Financial education. The pursuit of financial education should become a habit for you. After you make your financial plan and read the books I recommended, you should make it a habit to read at least one good financial book every year. In addition, you should read a good financial blog and read 5 to 10 of their posts per month. In this video, I have mentioned Dave Ramsey a lot and based much of the financial planning section on his steps to financial independence. Therefore, I would recommend reading his blog at ramseysolutions.com for more personal finance information. I also like to read Investopedia because the articles explain finance on many levels, which makes it appropriate for different groups interested in financial education. Okay, recap time. As future medical professionals that will be financially educated, we have the responsibility to be financially literate and to act financially conscious. There are 3 steps to becoming financially literate. 1, educating yourself through courses, blogs, and books. 2, putting a realistic written financial plan in place for yourself. And 3, prioritizing your continuing financial education. In future videos for this Financial Literacy for Medical Professionals course, we will cover how to act financially conscious. This video covered the foundations of financial success, financial literacy, so that when we lay down the building blocks for being financially conscious, you already have a sturdy foundation to build on. And when I say financially literate, I mean you know what to do. You know the theory behind finance. You know what a financial plan is. You know what assets and liabilities are. But to be financially conscious, it means to take these items and these terms that you learned and to insert them in your life, or to think in terms of these things. When you buy something, you should be thinking to yourself, is this an asset or is this a liability? Or is this a liability that will turn into an asset in the future? And hopefully that makes sense. And if this does make sense and you like this content, these videos, then watch the next one, okay? So you can learn about financial consciousness. Okay.